Okay, good evening. All right. Can you hear me? Can you see me, Caitlin? Is this working fine? Yes. Okay. All right. So, welcome. Tonight we must talk about, well, let's say three different topics, but the two first topics are connected. I actually divided in the syllabus. I think it's pretty much together. But to me, it made more sense to split it into two parts. It's about inequality. The first part that we need to discuss tonight is how do we measure inequality in an economy? It could be income or wealth inequality, doesn't matter. And then, all right, once we have measured the extent of inequality, what can we do as the government if we want to reduce the gap between high income and low income households in an economy? And yes, it is better to use this terminology rather than saying the rich and the poor. I know the students, they often say that rich people, poor people. It just sounds more professional if they write high income households, low income households. All right, so you should advise them to use this terminology when answering data responses or when writing essays as well. All right, so what policy instruments can we use to reduce inequalities? Of course, this is not really about efficiency, even though we could argue that inequalities can create inefficiencies. It's mostly a problem of equity, mostly a problem of fairness. Remember that there are basically, to keep things simple, two main reasons for which governments might want to intervene in the economy. Reason number one, to correct market failures and to improve efficiency. Reason number two, to reduce inequalities and improve equity or fairness. All right, so these are the two main reasons. Basically, we should not regard inequalities as a market failure. All right, it's not a problem of efficiency, it's mostly about fairness. So it is subjective, it is normative, whereas market failures is mostly positive. Okay, we can determine objectively when the market is efficient, as long as we have good information about what's going on in that market. Right, and the last thing that we have to do, which is basically a summary of things that we have already mentioned, is to talk about the limitations of government intervention, basically the different problems that can arise when the government intervenes in the market, in the economy, either to correct a market failure or to reduce inequalities, and we call that government failure. So that's basically all the things that can go wrong when the government tries to improve things in an economy. All right, okay. And then next week, we'll be able to start discussing the last topic of this chapter, which is about the labor market. It is probably the most, one of the most challenging topic in A2 economics. And for that reason, I have decided to divide it into two parts. So we will do part one next week. So if you have already signed up, if you have already registered for the labor market, you have registered for next week, part one. And I have created another event in 2 weeks from now, which is going to be our last workshop together for part two. Okay, so this is a new event, so you probably have not yet registered for this last workshop. So if you are interested, you know where and how to register. Okay, so let's get started and let's talk about the measurement of income inequality. And of course, Caitlin, because again, it's only you tonight. So if you have any question, just type them in the chat box and then I will take the time to answer. All right, let's go. Right, so the first thing that we have to introduce is the concept of the Lorenz curve, because we will use that to eventually calculate the Gini coefficient. So that's we need to introduce this first. So what is it? It's a curve that we can use to represent inequality. Could be inequality of income, could be inequality of wealth, and actually could be inequality of anything. But yes, usually for A2 economics, we mostly do income and wealth. All right, let me just show you how it looks like, and then I will go back a bit earlier. So this is the set of axes that we use. On the horizontal axis, we have the cumulative share of households from lowest to highest income. Okay. And on the vertical axis, we have the cumulative share of income earned. All right. So if I take sometimes students are a bit puzzled about this. So basically, if I take this value here, all right, then what do I have here? Let's try to understand how this works. All right, so something like that. And let's say that this is 40%. Why is this green? Let's just put it blue, just like the rest. Okay. So what we have here actually is to the left, it's the 40% with the lowest income. Up. That's what we have here. And what we have to the right is the 60% of the population with the highest income. Okay, so that's what we mean by cumulative share of households from lowest to highest income. Okay, it's like if as you move from 0% to 100%, it's like if you start including more and more households, and each additional household that you add is richer than the previous one. Okay, and of course, cumulative share of income earned basically tells you, okay, together, if you take for example, the 40% of the population with the lowest income, overall, if you add up all of their income, what percentage of the total national income do they make? Okay, and of course, it must be less than 40% because they are the ones with the lowest income. So, for example, you could say something like we often say the bottom 40% in terms of income, of course, the bottom 40% of the population altogether, they earn only 25-30% of total national income. So this is what the type of sentences that you can make when you see a Lorentz curve. And so basically it's a box, okay? It goes from 0 to 1 or 0%, 100%, it doesn't matter. So it's a box 100 times 100 or 1 by 1. And of course, the Lorentz curve will always start from 0. Okay, it will always start from, let's put some beautiful stars, always starts from there, because obviously if you take 0% of the population, they have nothing, so they have 0%. And obviously, it will finish here. Because if you take everyone, 100% of the population, obviously, overall, they are going to make to get 100%. Caitlin, you said, does the income include wealth? No, income is just a stream of money that you earn over a given period of time. So it could be your salary over a year, but usually we can look at the GDP per capita over one given year. Wealth is so basically, you could say that wealth includes income if you save some of your income, of course, the income that you save is going to increase your wealth, or perhaps if you use your income to buy a house, this is going to be part of your wealth, so it's going to increase your wealth. However, if you use your income to buy a bottle of wine or a beer, it's not going to increase your wealth, of course. So you could say that your income, depending on how you use it, can increase your wealth. But what you said, does income include wealth? No, that doesn't make sense this way. A yearly based measure, it depends, but yes, usually when we calculate a Lorentz curve, we look at the annual income. The annual income of households, because we simply use the GDP. We can use information about how much income they receive over a given period of time, and you look at different parts of the population, and just by surveying the population, just to find out, all right, how is income distributed in this economy. So yes, but it doesn't have to be. You could do that with using monthly income, but most of the time we use annual income. Okay, let's go back a bit just to give some more precise definitions. All right, so horizontal axis, we have the cumulative share of people from lowest to highest income, or wealth, of course, but I will mostly focus on income here. And vertical axis, the cumulative share of income. Okay, and then yes, if you look at one point on the Lorenz curve, you can make sentences like that, and it's very important for your students to be able to interpret those points as precisely as possible. So they can say something like, yes, the bottom 20% of all households altogether, they earn only 10% of total income. And when you think about it, if we lived in a society where everybody would be equal, in the sense that where everybody would make exactly or would earn exactly the same income, then if you take, for example, the bottom 50% of the population, well, altogether, they make 50% of total income. All right, if everybody earns exactly the same thing, which means that in that case, the Lorenz curve is just a straight line that goes from 0 to 1 with a 45-degree slope. And we call that the line of perfect equality. So the line of perfect equality is basically this. Okay, so it goes from 0 to this point to this point. It's a straight line, continuous, increasing. And of course, if you take, for example, the 70% of the population, because everybody is equal, they make exactly 70% of total income. If you take 30% of the population, collectively, they make 30% of total income. All right. So this would be the ideal situation. Well, ideal in terms of equity, in terms of fairness, where everybody earns exactly the same income. All right, line of perfect equality. Okay, so yes, the bottom n% of society always makes n% of total income. So yes, basically this line of perfect equality simply has the equation y is equal to x, okay, 45-degree straight line. If we look at the opposite case, again, that's extreme, but it's always useful as a benchmark. This is what we call the line of perfect inequality. So this would be a situation where basically everyone has nothing apart from one individual or one household. Okay, so 99.99999% of the population has an income of 0. They have a wealth of 0, doesn't matter. They have absolutely nothing. And you only have one household that has everything. Okay, so of course it's theoretical, but we can represent that, and we can graph what we call the line of perfect inequality. And essentially the line of perfect inequality, so as long you start including people, but the lowest, the bottom 99.9999% of the population, they don't have anything. So you can add as many as you want. The percentage of income earned is still 0, until you add the last household, okay, until you have really you reach 100%, and then basically the percentage of income earned, as soon as you add the last household, jumps to 100%. Okay, so it would be 0, and then suddenly it would jump at 100%. All right. So if you combine, so this would be the most unequal distribution of income. So in that case, for example, if you take the bottom 70% of the population, they have nothing. If you take the bottom 30% of the population, they have nothing either. So basically, we have this green line, which is the line of perfect equality. We have this red line, which is the line of perfect inequality. And of course, these are the two extreme cases. In practice, we are always somewhere in between. Okay, so the Lorenz curve will always lie somewhere in between. So of course, it will start from this point here. It will end up here, but it's not going to be as extreme as those two benchmarks. And of course, it is increasing. The Lorenz curve is increasing because as you add more households, they will always altogether earn a larger percentage of total income. And usually we can prove that it's also convex. Okay, let me just show you. Blah, 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 blah. So convex means that it will have basically, okay, just give me a second. Basically, it means it will have this shape, okay? All right, something like that. It's not possible, because you could wonder, right? You could wonder, is this possible that it has, let's say, this shape? Something like that. Zoom, zoom, zoom. Why not, right? But you can actually prove that no, this well, under certain assumptions, it's not possible, right? So it's just going to be increasing and convex. Convex in that case means it becomes steeper and steeper. Okay, just like that. Okay, right. Let's just go back to summarize a few things. Okay, so the line of perfect inequality, we have it there. And of course, as you can imagine, the closer when we draw the Lorentz curve, the closer we are from the line of perfect equality, then the lower the inequality. Okay, and the closer we are to the line of perfect inequality, the more important the inequality, or the wider the gap between high income and low income households in the economy. So just looking at the shape is quite useful, because simply looking at the shape of the Lorentz curve, you can already tell whether income distribution is relatively equal or relatively unequal. And in particular, if you have the Lorentz curves of two countries, you can, just looking at the shape of those Lorentz curves, you can determine in which country the income inequalities are the most significant. I'm going to show you that in a minute. And yes, the basic rule is that the more bent it is, the greater the degree of inequality. Okay, because if it's like almost a straight line, it means that we are very close to the line of perfect equality, a very low inequality in this economy. But if it's really bent very close to the line of perfect inequality, well, income inequalities are very significant. And yes, basically, it starts from 0, 0 and ends at 1, 1 or 100%, 100%. It is always increasing and convex. And of course, it's always going to be between the line of perfect inequality and the line of perfect equality. No surprise here. Okay, so it's going to be there. Could be something. So if it is like that, of course, if it is a 45-degree straight line, this would mean that, oh, our economy is perfectly equal. Everybody has exactly the same income. Okay, but of course, in practice, it doesn't exist. If we have something like that, so in green, we still have the line of perfect equality. So we are not too far. You see that the Lorentz curve is bent, okay, but not that much. We are relatively close to this line of perfect inequality. So we can say that the distribution of income is rather equal. There are inequalities, but they are not so significant. However, if you see something like that, where your line of your Lorentz curve is very much bent, very far from your line of perfect equality and rather close to the line of perfect inequality, then you can say that, well, in this case, income distribution is rather unequal. And of course, if it is there, if this is your Lorentz curve, well, you see that it is the same as the line of perfect inequality. So you would have distribution of income that is perfectly unequal. Okay, but of course, these two cases, this one and this one, they are mostly theoretical. It doesn't exist in the real world. We either have something like this or like this. Okay, more or less equal. All right, and you can actually, as I said, it's very useful, because if you represent the Lorentz curve of two countries, country A and country B, well, simply looking at that diagram, you can tell in which country you have the greatest or the highest degree of inequality. And clearly, the Lorentz curve of country B is more bent than the Lorentz curve of country A, and therefore we can conclude that inequalities are more important in country B than in country A. All right, and we can actually show it. If I take, for example, 70% the bottom 70% of the population in both countries, so the 70% of households with the lowest income, I see that in country A, altogether, they earn 52% of total income. All right, so it's not bad. However, in country B, they only earn 18% of total income. So, well, that's quite low in this case, very significant inequalities. Okay, this is, again, this is very important that we are able to interpret these figures properly and that we can make good sentences to explain what information is given by this diagram. Okay, then what I did, but it's up to you if you want to do that with your students, feel free to do so. You feel free to change the names also of households. These are just people. I actually use names of friends of mine, but of course these are French names. So you might want to replace that with English names if you want to pronounce them properly. I can just give you the pronunciation just in case. So we have Lydia, Céline, Thibaut, Anthony, and Matthias. But yeah, maybe easier if you change the names, right? All right. And actually, I wanted to show my students how you can build a Lorentz curve simply using information about how much money they make. All right. So we have five people, five different households in this economy. So of course, each of them represents 20% of the population, okay, 1/5. And you see what I did? I actually ordered them from lowest income, monthly income, to highest income. Okay, so just keep things simple. All right. So basically, I introduce households one by one from lowest income to highest income. And of course, as I include additional people, the cumulative share of income increases by 20%. Okay, so for example, if I include Lydia, Céline, and Thibaut, I have the bottom 60% of my population. And then I can do exactly the same thing for the share of income. Okay, of course, as I include more and more households, the total income that they earn together increases. All right. So here I have their individual share of income. Okay, so for example, Lydia earns 12% of total income. Céline earns 50% of total income. And as I include them one by one, I can calculate the total income that they earn overall. And of course, the cumulative share will increase. So for example, if I only include Lydia, Céline, and Thibaut, so I have the bottom 60% of my population, altogether, they earn 44% of total income. Okay, if now I include the one additional household, Anthony, I can say that the bottom 80% of the population, altogether, they earn 71% of total income. And of course, if I include everyone altogether, they earn 100% of total income. And then, well, using this information, I just need these two columns, okay, the cumulative share of households, which is going to be on my horizontal axis, the cumulative share of income, that's going to be what I have on my vertical axis. And simply with those two columns, I can represent this Lorentz curve. Okay, so this is the Lorentz curve of my population using the data that is available in the table. Yeah, so I think it's interesting just to show them that it's not very complicated. With very simple data, you can actually calculate all the information that you need to be able to build a Lorentz curve. Okay, and yes, you can interpret some points that lie on this Lorentz curve. For this particular topic, it's very useful to include some data from countries about income distributions. I think the data was updated last year, but of course it changes rather on a regular basis. So what you should do is really to update the data year after year, because it can change quite significantly. So I think the data is relatively up to date, but you should double check before you use that. So here, what do we have? So top 20%. So how do we read that table? The figure we have here tells you if you take the 20% of households in terms of income, so the 20% of the household with the highest income, what is the percentage of total income that they make? And of course, this top 10 is the list of countries with the highest inequalities. All right. For example, in South Africa, which is infamous for having the largest or the most significant inequalities in the world, if you take the 20% of households with the highest income, altogether, they earn pretty much 70% of total income. And you see that these are mostly African countries. So yes, there are many African countries, all of them, right? Yes, all of them. African countries which are famous, well, infamous for having very large income inequalities. And the right-hand side of the table, those two columns, so it's the same thing with the bottom 20%. And again, we have the countries with the largest inequality, okay? Careful, this does not mean that this is the lowest inequality and the highest inequality. In both cases, we have countries with very significant inequalities. So here, how do we interpret the data? Again, we take the 20% of households with the lowest income, and the figure here tells us altogether how much they make or how much they earn. So for example, in Suriname, if you take the poorest 20% of the population, they only altogether, if you added their income, what they have together only accounts for 1% of national income. No, well, usually I do it separately, Kate. And you ask, should we consider that together? First, I start by looking at the top 20%, and then it's different, right? It's I could have two tables. The fact that they belong to the same table does not mean that you have to do this together, that there is a link between the two. This is just, I wanted to show the two ends of income distribution for top 20%, bottom 20%, but they do not really go together. Again, we have almost only African countries apart from Venezuela, right? I think that's the only one, Venezuela. But apart from that, only African countries. Yeah, again. This is the US. So here it's a bit different. We have different, I'm not sure how to pronounce that properly, quintiles, right? I think a quintile, I hope I have the pronunciation right, is basically 20% of the population. Okay, so bottom quintile means the bottom 20%. A second quintile is like from 20% to 40%. The third from 40% to 60%. The fourth from 60 to 80%, and the top quintile, the top 20% of the population. And you even have the top 5% of the population. What we have the income bracket. So W is income. It basically tells you, all right, what should be your income, and careful, this is for households, okay? This is not for individuals, for households. What should be your income for you to be part of the bottom quintile, second quintile, and so on? You have the average annual income of those who belong to each of those section of the population, or all those brackets. And you have the percentage of total income that they earn. So you see, it's a bit outdated, 2012, but to be honest, I struggled to find more recent information last year. I found it quite difficult. But this would be great if you are motivated, you can try to update this table, because it's been almost 10 years and I'm sure things have changed a lot. All right. So for example, in the United States, almost 10 years ago, if you took the 5% of the population with the highest income altogether, they earned more than 22% of total income. On the other hand, if you take the 20% in the US of the lowest income earners, then they only, collectively, they only earned basically 3% of total income. And I think the averages are interesting, right? Like top 5%, over $300,000 per year. That's comfortable, right? Okay. So yes, feel free to use a lot of information, real life examples to basically apply the concept of that Lorenz curve to specific cases. Okay, Caitlin, do you have any questions up to now about Lorenz curve before we talk about the Gini coefficient? No questions? Okay. All right. Let's move on. Let's talk about the Gini coefficient. It's quite simple, but first we should understand what is the purpose of the Gini coefficient? Because basically what I told you is that, yeah, we can simply look at the shape, right? We can look at the shape and we can say, yeah, look, this one is more bent than this one. Therefore, there is a greater inequality. Yeah, it's true, but it's a bit imprecise, right? It's not very precise. It's a bit vague. Basically, what we want is something that is a bit more precise, easier to interpret, and well, would be useful to have a value, right? To have a value, a figure that we can use to assess the size of inequalities, and especially to compare inequalities between countries without having to compare curves of 10, 20 countries. It's going to be a mess if we draw 20 Lorenz curves on the same diagram. So basically, the idea is, okay, let's try to find out how we can represent this inequality just using a number. And the intuition is quite easy. All right, if this is the line of perfect equality in green, and if this is the line of this is the Lorenz curve in blue, well, we can actually divide the diagram in two areas. Okay, let me just do it. We can call this one, okay, let's say that this area between the line of perfect equality and the Lorenz curve is A, and the area between the Lorenz curve and the line of perfect inequality, let's call that B. Of course, A plus B is equal to 1/2. Okay, why? Because this distance here, 100% is 1. Okay, here we have again 1, so 1 times 1 divided by 2, that's the area of this big triangle. Okay, so this big triangle has an area of 1/2. And something that is obvious is that if we have very big inequalities, area A is going to be very big and area B is going to be very small. Okay, if we have a situation like that, if we have very large inequalities, oops, sorry, it's not very clean. If we have very big, very big inequalities, area A is going to be very large and B is going to be very small. And on the other hand, if we have very low inequalities, so something like that, area A is going to be very small and area B is going to be very large. Okay, so the idea behind the Gini coefficient is say, okay, maybe we can simply calculate the percentage of A, of area A in this triangle, okay, to see how big area A in this triangle. Okay, so we can simply divide A by A plus B. Okay, so, and A plus B is 1/2. So it's just A divided by 1/2, which is 2A. All right, amazing. We have the Gini coefficient. That's it. Pretty simple. And of course, if you have a perfect equality, A is equal to 0, and therefore your Gini coefficient is equal to 0. And if you have perfect inequality, A is equal to 1/2, and therefore 2a is equal to 1. So it's very cool because that means that the Gini coefficient ranges from 0 to 1. 0 indicates perfect equality, and 1 indicates perfect inequality. Okay, and that's it. That's really it with the Gini coefficient. This is how we calculate it. All right, so let's just explain that. Yes. Okay, so basically it's based on the idea that the larger the area between the Lorentz curve and the line of perfect equality, the greater the degree of inequality. If we denote A, if we call A this area, then if we have perfect equality, A is equal to 0. If we have perfect inequality, A is equal to 1/2, but we don't really want our coefficient to range from 0 to 1/2 because we like when an index ranges from 0 to 1. So we just multiply by 2. All right, so you multiply by 2 and you call that, hey, that's our Gini coefficient. And of course, the lower it is, the lower income inequality. Pretty easy. Okay, so if it's high, it's not good in terms of income distribution. If it's very low, it's a good sign, or at least it indicates that there are low inequalities. Okay, so that's how you can calculate it. I don't like this equation because to me it's a bit stupid because A plus B is always equal to 1/2. So it might help, this equation might help to understand that yes, the Gini coefficient measures the proportion of area A in the big triangle. Okay, yes, but A plus B is always equal to 1/2. So actually I like this formula better, just G is equal to 2A. So it would actually be this area. If this is A, if you double it, and this area would be your Gini coefficient. Okay, you don't have to use this diagram. I think it's easy to understand, but you don't have to do it. Okay, so 2 times A, that's your Gini coefficient. And yeah, it can either become a broader if you have more inequalities, or thinner if you have less inequalities. Okay, this would be your Gini coefficient. Okay, so same thing. I actually remember my example with my friends. Here, you can actually calculate the Gini coefficient, but it's a bit annoying because you see that there are several sections. I did it, but I really suggest you don't do it because it's just a pure calculation and it's not very interesting. But for those who are a bit curious, you can actually calculate the Gini coefficient and you would find 0.09, which, oh, sorry, 0.18, which is very low. It's this would be among the countries with the lowest income inequality. Yeah, you feel free to do so if you are interested, but students will never have to calculate a Gini coefficient during exams, so it's not necessary to do it. Again, some data from various countries around the world. So this is 2018, so maybe not perfectly up to date, but I don't think things have changed so much over the last 3 years. So again, remember that it goes from 0 to 1, and if it's very high, it's not. It means that there are big inequalities in terms of income, and if it's very low, it means that there are low income inequalities. So what do we notice? Again, most countries who are like the top 10 with the highest income inequality based on the Gini coefficient are mostly African countries and countries from, well, actually it's pretty diverse, right? We have so South Africa, Namibia, Zambia, Lesotho, okay, African countries. Then we have China, India, Sri Lanka, Asia. And we have the Philippines, which we can also consider Southeast Asia, I guess. And we have South America or Latin America with Honduras and Colombia. So you see that which means that very high income inequalities. We don't have developed countries. Yes, this we see. No developed countries in this list. Some countries are very poor, like Zambia. Others are emerging economies, or even what we call newly industrialized countries. like about to become developed, like we have two BRICS: Brazil, Russia, India, China. So three actually. We have China, India, and South Africa. So three members of the BRICS, but no developed countries. So you see that all of them basically they have a Gini coefficient that is about 0.5, okay, or above, but 0.5 is among the highest. Data from China's web shows that the Gini in 2010 is 0.48, you're saying. So the problem with the Gini coefficient, it's a good point that you raised, Caitlin, is that in most countries, it's not calculated every year. So that makes it a bit complicated to compare. Let me just, no, I will not be able to access Wikipedia. But if you go to Wikipedia, I don't have my VPN on, but if you go to Wikipedia and you type countries by Gini coefficient, you will find a ranking. But in the ranking, they also give you the year during which the Gini coefficient was last calculated. In most developed countries, it's calculated on a regular basis. So you might find 2020, 2019, 2018. But in other countries, it's like the last measure you have can be 2012, 2010. It might be difficult to find up-to-date data. And that makes it difficult to compare, okay? Because the data you have for different countries has been measured at different points in time, so it's a bit difficult to compare. But yeah, China has a pretty significant income inequalities. Yes, it is one of the countries in the world with the highest income inequality, at least based on the Gini coefficient indicator. If we look at the right-hand side table, which shows which countries in the world have the lowest income inequality, well, we see that we basically have overall two types of countries. We have what we call the Scandinavian countries, countries from Northern Europe. So what we have: Iceland, Norway, Finland, Sweden. Okay, let's include Denmark. Yes, and then we have countries from Eastern Europe. We have Czech Republic, Slovenia, Slovak Republic, and Ukraine. So yeah, these two groups of countries are known for having very low income inequalities, basically with a Gini coefficient that is below 0.25. Belgium is is a bit outstanding here. All right, and you have a world map, so you see there are many holes in this map. There are many countries for which you don't really have data. There are a lot of African countries, some countries in South America as well. We have Papua New Guinea. We have some countries in Southeast Asia as well. Of course, North Korea. We don't have like Saudi Arabia, Yemen. We don't have Iran. So yeah, we are missing quite a few countries. But that being said, we see that European countries, like Western European countries and even Eastern European countries, have so careful here, because red means low inequalities. Okay, it's a bit counterintuitive, but red means low Gini coefficient and therefore low inequalities. And on the other hand, green means high Gini coefficient and therefore higher inequalities. And we see something that is quite interesting. We see that all the BRICS, pretty much all of them, apart from Russia, which is not that bad, but they have high income inequalities. So Brazil, yes, Russia, India, China, South Africa. So all of them pretty high income inequalities. And then mostly, you see, it's mostly developed countries who have low income inequalities. So we have Japan, Australia, New Zealand, Canada, and okay, Scandinavian countries. There are exceptions, of course. You see that the US, for example, is not doing amazing, pretty high inequalities in the US. We have Spain, we have Portugal. Who else did I forget? Developed countries. All right, and then there are exceptions. You see that sometimes it's a bit tricky because you have very poor countries, sometimes in Africa, that have relatively low inequalities. So it's the bottom line is that, can we use income inequality? Can we use the Gini coefficient to determine whether a country is developed or not? Not really. If you look at this big country here, I think it's Kazakhstan, correct? I think it's Kazakhstan. If you look at Kazakhstan, it's definitely not a developed country, but very low income inequality. Yeah. And if you look at a country with a very high income inequality, it doesn't mean that it's a poor country. Okay, if you look at like Mexico, for example, all right, Mexico is not a poor country. It's still a developing country, but it's not among the least developed countries, but very high income inequalities. So yeah, the bottom line is that it's really hard to use the Gini coefficient and to use income inequalities overall to determine the level of economic development of a country. And this idea is can be understood through what we call the Kuznets curve, which relates the level of economic development measured by the real GDP per capita to the size of income inequalities. And basically the idea behind the Kuznets curve is that as a country develops, if we start from being very, very poor at first, when we are very poor, everybody is poor. So it's very bad, but at least there are no inequalities. Okay, everybody, well, most of the population, they live in the countryside. They are farmers. Everybody is poor, very low quality of life, but low inequalities. Okay, so the Gini coefficient is very low. Then as the country develops, what usually happens is that you have a very fast urbanization process where basically your population can now be divided into two groups: the urban population, who usually earn more on average. Okay, that's why they move to cities, because they hope they can make more money and have a better quality of life. And those who still live in the countryside, the rural population. And this urbanization process is likely to increase the gap in income between urban and rural population. So the idea is that as the country develops, income inequalities are going to increase, and this is going to be represented by an increase in the Gini coefficient. But then the idea is that once we have reached a certain level of economic development, then it's often the case that governments, they implement policies that are aimed at reducing those inequalities, to redistribute income, to support those on low income. And we'll see what we can do to achieve that, to use progressive taxation benefits to essentially improve equity, reduce the gap between high and low income households. And therefore, the idea is that as a country keeps developing, because of this government intervention, inequalities will eventually start to fall. So the Gini coefficient will eventually decrease. And that may be the reason for which we see on the map that most countries with very low income inequalities are those with a very high level of economic development. And the idea is that, yes, that's because governments have implemented a lot of policies to achieve that. But then we should, if we look at very poor countries, if we use this Kuznets curve argument, in very poor countries, we should also find very low income inequalities. On this particular map, it is quite difficult to tell, because you see that the poorest country in the world, we don't even have data, so it's a bit hard to tell. But it's not necessarily the case. If I go back here, right. If I look at, for example, Zambia or even Namibia, they are pretty poor countries, among the poorest in the world, especially Zambia. And still, they have very high income inequalities. So it seems like it's this Kuznets curve argument doesn't really make sense, unless perhaps even the poorest country in the world have already engaged their level of economic development. But that's really the main criticism that we can make, is that this theory, okay, we can understand the logic, but in practice, it doesn't seem to be much supported by empirical evidence. It's not always supported by the data. Same thing, if you look at the United States, well, we still have pretty high income inequality. If we look at South Africa, which is not yet completely developed, but about to become a developed country, still very, very high income inequality. So what your students must know is the idea. They must be able to explain the Kuznets curve, to explain the intuition behind the Kuznets curve, but they must remain aware that in practice, it doesn't work very well, okay? All right, so that's the idea, basically. As a country develops, at first, income inequalities will widen, but then after a certain income level per capita, it will eventually, income inequalities will eventually decrease, all right? And the intuition, I gave it to you, okay? First, urbanization process widens the gap between the urban and rural population. And then once we have reached a certain level of economic development, government intervention, especially the use of progressive taxation and benefits, will eventually reduce inequalities. Okay, but again, data does not strongly support this hypothesis. All right, a few things to conclude. Yes, extreme inequality can result in political instability. All right, basically, people are a bit angry or find that it's unfair, especially when you have a wealthy minority that controls the country, that imposes its decisions to the rest of the population. Remember that if you have more, especially when we calculate the relative poverty, but we'll see that later, a country can experience a high relative poverty rate because there are high inequalities in the country. Remember that relative poverty measures inequality rather than poverty. And okay, the last one is not very important. Okay, these 3 bullet points, this was some leftover. I did not really know where to put it. Still, it sounded interesting, so I did not want to remove it, but it is not as important as what we have already done so far. All right, Caitlin, do you have any question about this topic before we move on and talk about income redistribution? No? Okay. All right. Okay. All right, a few questions to warm up. That's usually what I do with the students. When you print the PPT, make sure you delete the answers. The difference between income and wealth, it's always interesting to just remind them what it is. Income is basically a flow of money that you receive because you have sold or rented a factor of production. Often we talk about salary or wage because that's mostly what we mean by income. But of course, there are other sources of income: rent, interest, profit. Okay, but it's okay to focus on salary. Wealth is a stock. A stock, careful, I'm not talking about a company stock or share. I'm talking about, when I mean the stock, I mean an accumulation, okay? Something that grows over time. It's not a flow. A stock is the opposite of a flow. Basically, a stock is what you can build up over time as you receive a flow of income on a monthly basis, for example. So yes, income is a flow of money. Wealth is a stock of assets. Easy, right, to distinguish. Income only includes money. Wealth includes money, of course, money you have on your savings account, but it also includes other assets. Could be financial assets like stocks, bonds, blah, 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 or physical assets, okay? A house, a car, expensive jewelries, they are part of your wealth. All right, so this is the difference. It's important to make that very clear. Second, what is the difference between efficiency and equity? All right, it's always good to review. Efficiency, it's about resource allocation and whether we have allocated the resources in the best possible way, especially in terms of have we produced in the most efficient way? Have we wasted any resources in the production process? That's the concept of productive efficiency. And also, have we allocated resources to produce the goods and services that provide the largest possible satisfaction? This is the concept of allocative efficiency. Basically, if you want to explain both concepts of efficiency in one single sentence, we will say that economic efficiency is achieved if the economy's scarce resources are used to produce the output mix that maximizes or that produces the largest possible satisfaction in the economy, or that satisfies as many needs and wants as possible, something like that. Equity is very different. Equity is just about the idea of fairness, the idea of justice. Right? Is especially in terms of income distribution, wealth distribution. So very different. Efficiency, yes, scarce resources are used in the best possible way. Your A2 students, they must be bulletproof on efficiency. Equity, fairness, justice, such as income distribution. And then quite important, the difference between equality and equity. And I know many teachers use that picture or this drawing, but it's very famous and it is extremely clear. So I'm sure you have already seen that before. And I don't think there is the need to make any additional comment. Yeah, equality means to be treated the same regardless of your individual characteristics. Equity is about allocating resources or depending on the needs of each individual. So we take this into account. I think I gave a definition. Yes, all right. So equality is something objective. All right, you just give the same thing to everyone. It doesn't matter. Doesn't matter what your individual characteristics are. All right, I have 4 apples. They are 4 individuals. Everyone gets one. Period. Easy. Equity is more subjective. Okay, it's really it relates to, yes, the idea of fairness, of justice. So, for example, if we still have those 4 apples and 4 individuals, so equality would just say, okay, you give one each. Equity, we would look at the individual characteristics. So for example, if you have 2 of them who are starving and the 2 others who have just had lunch and are not particularly hungry, well, in that case, most of us would agree that it's fair to give the 4 apples to the 2 individuals who are starving. Okay, so we do take into account their individual characteristics when deciding how to allocate resources. Clearly, it's not equal. But again, most, and this is why I underline might and some, because some people might still feel like it's unfair and there is no because fairness depends on our beliefs. But most people would agree on the fact that it is fair to give all 4 apples to the 2 individuals who are starving. That's the difference between equality and equity. And something that we have already mentioned in AS when we talked about the canons of taxation, it's the difference between horizontal equity and vertical equity. So I'm not going to talk about that again, but yeah, basically when we talked about taxes, we said that a tax was horizontally equitable if you had 2 taxpayers in the same situation, okay, with the same characteristics in terms of income or wealth or profit, it doesn't matter. Well, if the tax is horizontally equitable, these 2 taxpayers should pay the same amount. And vertical equity is about would be a situation where if you have 2 taxpayers, one who earns more than the other, then the household who earns more, makes more profit, or doesn't matter, should either pay more or face a higher tax rate. Okay, it depends. Okay, but basically they should not be treated the same. They should not be treated the same way if they have different characteristics. All right, most people would agree that it is fair if a billionaire pays more tax than me. Okay, because of course the amount of tax that you pay and even the tax rate that you face, most people would agree to say that it should be connected to the amount of money you make or you have, your wealth or your income. All right. Okay, so horizontal and vertical equity. Right, so how can we redistribute income? There are essentially, let's say, 2+1 methods. Method 1, progressive taxation, already studied in AS. Method 2, benefits, especially means-tested benefits. Method 2+1, well, just a combination of the two. Taxation plus benefits, a system that we call negative income tax, NIT. All right. So actually, apart from the negative income tax system, all of it is part of the AS syllabus. So I'm going to move pretty quickly on this and mostly just highlight the key ideas. But again, you should not assume that your students perfectly remember everything about progressive taxation. You should not assume that they remember everything about benefits. So it's always good to use this module, this A2 chapter, to review what you have taught them last year in AS. All right. Okay. Yes. So, of course, in the previous chapter, what we did last week, we saw that, yes, when there is a market failure, when there is a loss in efficiency, the government might want to intervene to make things better. However, that's not the only reason. Another reason, as I said at the beginning of today's workshop, is that the government might want to intervene in the market to reduce inequalities, okay, and eventually achieve an income or wealth distribution that is believed to be more fair. Something that is quite interesting is that very often you will have and that's a very good evaluative comment that you can make or that your students can make when they write an essay. Very often it is quite hard to achieve efficiency and fairness at the same time. And most of the time, policies that will aim at improving efficiency, they are often unfair. So they reduce equity. And policies that are aimed at improving equity, they are usually inefficient. So yeah, it's a bit of a problem. It's a very interesting thing that students can write. So basically, you could really see it like this, where you have like efficiency on the one hand. All right, equity on the other end of the spectrum, fairness. And yeah, it's really hard to just find an example, and you can challenge your students. You can say, okay, try to find an example of a policy that will improve both efficiency and equity. Pretty hard. Let me just discuss two examples of policies that improve either efficiency and decrease equity, or improve equity and reduce efficiency. So for example, carbon tax. Carbon taxation, of course, it's a tax that is aimed at reducing a negative externality. Okay, so it's a tax that is meant to move in this direction. Okay, more efficiency. Why is this going to lead to less equity? Because carbon taxes, they are indirect taxes. And what do we know about indirect taxes? They are regressive. And regressive taxes have a higher incidence on low-income households. And you probably heard about the yellow vest movement in France about three years ago, I think, which is basic like for one full year there were protests in France against the implementation of a carbon tax, because many people believe that this tax was unfair and was going to be mostly paid by poor people who basically have to drive every day to work, who live outside of cities because they can't afford to live inside the city, so they don't have access to public transportation. They have to drive 50 to 70 kilometers every day to go to work. And of course, with the carbon tax, it makes gas more expensive. So they were a bit upset about this policy, which clearly, in terms of efficiency, yeah, it's effective at decreasing negative externalities. All right, but it can be really considered unfair. So you see, more efficiency, less equity. If we look at the other example that I give, the poverty trap, so it's not something that I have explained in detail yet, but basically, well, you know what this is. A poverty trap is when you want to, for example, to give benefits to people who are unemployed. Okay, so if you want to give benefits to people who are unemployed, you want to improve equity. Okay, you want to do something that is fair, but why is this inefficient? Because it can discourage work, or it can reduce the incentives to work or to work more, and it can therefore lead to productive inefficiency, where you would have some resources that will not be used because of very low incentives to work. So you would definitely have an improvement in equity, in fairness, but at the expense of inefficiencies. So you see that, yeah, there is often this trade-off between efficiency and equity. And actually, maybe this is, I am oversimplifying, but I kind of find that this is a good way to understand the difference between left-wing political parties and right-wing political parties. Again, I am really oversimplifying things, but yes, you could argue that usually in most countries, right-wing political parties, they are mostly concerned by efficiency, or at least they attach more importance to efficiency, whereas left-wing political parties, they attach more importance to equity or fairness. And I think that, yeah, it's a pretty good description of what the core difference can be between left-wing and right-wing political parties. So at least in France, because of course the carbon tax can be, to answer your question, Katie, the carbon tax can be imposed on businesses, can be imposed on individuals. In France, the government wanted to impose it on gasoline. So anytime you refuel your car, well, you had to basically this was just an indirect tax, a specific tax, per unit tax on oil or gasoline, not oil, gasoline. So yeah, it's an indirect tax, and it was and we know that indirect taxes are regressive, and I'm going to refresh everyone's memory of why indirect taxes are regressive. So that's why many people believe that, hey, this is unfair, and they started to protest. Okay, so yeah, I think it's interesting to talk about this trade-off, and I think that there are many essay questions for which it is possible to discuss that. All right, so taxation. I'm not going to review everything about taxation, so please allow me to move quickly on that. Yes, difference between a direct and an indirect tax. Direct on basically personal organization, on income or wealth. Indirect tax, tax on expenditure on a good or service. Then I give the definition difference between the average tax rate, the marginal tax rate. Again, everything is just a summary from AS. So depending on your students, you might want to do that again, or you can skip it. You can briefly question them. All right. Actually, it's the marginal tax rate is not something that is so important. Okay, it's okay to skip it. You can focus on the average tax rate, which we simply call the tax rate. Okay, if you hear tax rate, well, we mostly talk about the we mostly talk about simply the average tax rate. Okay, well, and then, but of course, what is interesting is the different types of taxes. A tax can be progressive, proportional, regressive. All right, so progressive, the tax rate increases with income. Proportional, the tax rate is the same, doesn't change with income. Regressive, the tax rate decreases with income. And yes, usually direct taxes are progressive and indirect taxes are regressive. So in terms of income redistribution, progressive taxes can reduce the gap between the rich and the poor. However, regressive taxes, they are often considered unfair. Right. Okay, the graphical representation, they honestly, they don't matter too much. This is really something that you can skip. I don't think I saw any question where students are expected to interpret diagrams that show the relationship between total tax, marginal tax rate, average tax rate. So I recommend you skip those slides. What they must know is, of course, what is a direct tax, what is an indirect tax, what does it mean for tax to be progressive, regressive, proportional? If they know that, it's all good. All right. This is the income tax system in the UK. At least this was 1 or 2 years ago. So of course we have different tax brackets. What I usually like to do, but this is already something that is done in AS, so maybe you have already done it in AS, just to show them how we can actually calculate the income that has to be paid. Because again, if you tell them, all right, my income is £50,000, and if you ask them, all right, how much income tax do you have to pay? Many students will just say, okay, I just multiply £50,000 by 40%, okay, because £50,000 belongs to this bracket. But of course, you know that it's wrong, because what we have here is the tax on this income. So this is not how we proceed to calculate income tax. Well, I'm not going to explain, you know how this works, but just make sure that they do not mix up an average tax rate and the marginal tax rate. So take a few examples and walk them through the process of calculating how much total tax is will be paid for different incomes using information from that table. So of course, when we talk about income redistribution, we often talk about progressive taxation. But actually, even regressive taxation, you could argue, when you think about it, you could argue that even regressive taxes, they redistribute income, because even regressive taxes, they are such that rich people pay more than poor people. Like VAT, okay, VAT is an indirect tax. It is regressive, and I'll show you why it is regressive, but rich people pay more. So because they pay more, you could say that the income inequality after tax are less than the income inequality before tax, at least in absolute value. All right, so the gap in absolute value is going to narrow. But however, what matters is mostly, even though rich people pay more regressive taxes than poor people, they pay a lower share of their income. They face a lower tax rate. And that's why we often say that they face basically a lower burden, a lower tax burden than poor people, simply because, yes, the tax rate they face is lower. So in terms of fairness, which is basically what we are talking about in this chapter, yes, we often believe that the most effective way to reduce income inequality and to improve fairness is to implement progressive taxes, or to introduce progressive taxes, because, yeah, they will be the most effective reducing the gap between high income and low income households. Could be households, could be businesses, all right, if you talk about corporation tax, for example. Why do we say that it is the tax that is the most fair? Simply because by definition, people who make more money, who earn more income, they will pay a higher tax rate than those who pay a lower or who earn a lower income, right? So there is a lower incidence on poor people and a higher incidence on rich people. Yes, and because of that, the consequence is that the income inequality after tax, so the disposable income inequality, will be lower than the gross income inequality. Okay, the gap between the rich and the poor will narrow thanks to the introduction of that progressive taxation. So yeah, that's why we believe that this type of tax is more fair than proportional or regressive taxes. Okay, limitations. Again, this is something that was already discussed in AS, so please allow me to move rather quickly on this. Of course, we have the problem of the incentive to work. If the government imposes marginal tax rates that are too high for high income earners, this might discourage them from working longer, or accepting a promotion, for example. Or if tax rates increase too fast, this can even discourage people from taking a job. That's a situation that we call the poverty trap. We'll talk about that in more detail in a minute, in more details. We talked about tax avoidance and tax evasion in AS. Again, if you earn a very high income, you might have incentives to find ways around the tax system to reduce your liability. So if you do that legally by finding some loopholes, finding some tricks to reduce the amount that you owe, then we call that tax avoidance. And if you engage in illegal practices to reduce the amount that you pay, just like by lying, by misreport information, by hiding some of your assets or some of your money, then we call that tax evasion. This can also, the problem is that tax evasion, of course, you could have a situation where people will simply vote with their feet, just say, okay, voting with your feet simply means that you are unhappy about the fiscal situation in your country, so you just go somewhere else. Okay, France is the country in the world with the highest taxes. Okay, so a lot of people, and especially those who make a lot of money, they go to Belgium, they go to Switzerland, those tax havens in which there are very low tax rates, so they can keep more of their income. This may also undermine what we call trickle-down economics. Trickle-down economics is the idea that, oh, you should not tax rich people because rich people, they spend a lot of money, and eventually this money is going to spread throughout the entire economy. And therefore, if you tax rich people too much, they will spend less, and therefore this trickle-down economics, or this trickle-down effect, is going to be undermined, and then the entire economy will basically suffer from that, which is actually an argument that does not make much sense, because very high income earners, they have a very low marginal propensity to consume. Okay, so if you tax them more, they are not going to consume less, they are simply going to save less. Well, maybe they will consume a bit more, but the effect is going to be very weak. All right, so the idea of trickle-down economics is, well, usually an argument that is used by rich people who do not want their taxes to increase. Okay, okay, we already have that. Sorry, I already talked about horizontal and vertical equity. I duplicated this slide. Okay, so these are the main limitations of progressive taxation. Yes, poverty trap, very important for your students to talk about this one. Tax avoidance, tax evasion, yes, and the problem of trickle-down economics. Even if I honestly, I don't really think it's relevant in practice, but from a theoretical perspective, it is interesting, and it's interesting for your students to mention it when they write an essay about progressive taxation. Okay, something that we often say, but I actually found very few books that explain it, is the reason for which indirect taxes are regressive. Because we often say, yeah, VAT is regressive. Why? So what I did is that I created a very simple example just to show it. And why do we say that indirect taxes like VAT are regressive? Well, mostly because usually poor people have a very high average propensity to consume, and rich people have a very low average propensity to consume. So the APC, the average propensity to consume, is simply the share of your income that you spend on consumption. And of course, if you make just $1,000 per month, well, you're going to spend everything. Okay, so your average propensity to save is going to be close to 1. However, if you make $10,000 per month, you will be able to save most of your income. Perhaps you're going to consume $3,000 and you're going to save $7,000, and therefore your average propensity to consume is only going to be 0.3. And why does it explain why indirect taxes like VAT are regressive? Because of course, someone who's very poor and therefore consume 100% of his or her income will therefore pay VAT on 100% of their income. But if you only consume 30% of your income, well, you only pay VAT on 30% of your income. You don't pay VAT on your savings, of course. You pay maybe other taxes, but you don't pay VAT on your savings. So that's the idea. And you have some data from the UK where it basically shows you that if you take again the bottom 20% of the population in the UK in 2017, in terms of indirect taxes, they paid nearly 30% of the overall indirect taxes that were collected by the government in the UK. And on the other hand, if you take the top 20% of the population in the UK, they only paid 14% of the overall indirect taxes, which demonstrates, which gives evidence that yes, indirect taxes are indeed regressive. Here's a simple example. So we have Jimmy. So we are in the UK and the VAT rate is 20%. And Jimmy is quite poor, £1,000 per month. So he basically consumes almost everything. So an average propensity to consume of 0.9. So he basically consumes 90% of his income. So he consumes £900. He pays 20% of £900 in VAT. So this is his tax liability. He pays $180 pounds, in VAT. So we can calculate his average tax rate or his tax rate. That means that he faces a tax rate of 18%. Okay, let's say, so remember that. Jimmy, £1,000, 18% tax rate. Now let's take Amy. So Amy is much richer, £5,000 per month. So because of that, she can save much more. Okay, let's say she saves 60% of her income and she only consumes 40% of her income. Okay, so 40% of £5,000, that means she consumes for £2,000 and she pays 20%, so 20% of £2,000, that's £400. All right, so she pays £400 in VAT. So again, we can calculate the tax rate that she faces, only 8%. So of course, Amy pays more than Jimmy. Jimmy only paid £180. Amy pays £400. Does it mean that VAT is progressive? Of course not, because we don't look at how much we pay overall. We look at the tax rate that we face. And Amy is rich and she only pays 8% in VAT. Jimmy is poor and he pays 18%. Well, therefore, the tax rate decreases with income. Therefore, VAT is regressive. All right. And again, this is simply because Jimmy pays VAT on 90% of his income, whereas Amy only pays VAT on 40% of her income. That's it. It's a very simple example that you can use to illustrate why VAT is regressive. Yeah, the rich pay more than the poor in total, absolutely. So that's why I said that this can still help to narrow the gap between the rich and the poor, but it's often considered unfair because Jimmy, who has a lower income, pay a higher proportion of his income in VAT than Amy. Okay, so you could argue that Jimmy has a heavier tax burden than Amy. Does it make sense? Well, of course. And that's what I said. It's a percentage here in the data. It's the data here, right? It's a percentage. It's not they pay less. Yes, you're right. It's true. It's true. I understand what you say. My example here, there, Caitlin, is just there to illustrate why, to explain why VAT is often regressive. Yeah. You're right. In the data that we have here, it even shows, it goes one step further. It even shows that they even pay less overall. It's different. You're right. It's even different from what I illustrated. It's even more substantial here. I just wanted to show in this example that the tax rate decreases with income, even though Amy pays more. Why the rich pay less in total? You mean in this data? Yeah, not easy to explain. Could be because it's indirect, so you can't really use tax avoidance, you can't really use tax evasion. Yeah, I'm not quite sure about how we can, it definitely shows the regressivity of indirect taxes. How can we make sense out of it? Oh no, it's okay. It's okay. Sorry. I misread the data. No, it's a share of income. It's not, it doesn't mean that it does not mean that they pay more. All right. It's exactly the same thing. It means that they pay the most as a proportion of their disposable income. Okay. So on average, it's not that they paid 30% of total indirect taxes. On average, the bottom 20% of the population faced a tax rate of 30%, and the rich people faced on average a tax rate of 14%. But if we had the total amount that they paid, the top 20% would pay more than the bottom 20%. Okay, I misread the question. Yeah, it's not total amount. It's funny, we always say this to our students, please don't read too fast or you're going to make mistakes. And we do the same thing. All right, so it's exactly the same idea as my example. All right, we have often talked about, we have mostly talked about income. We haven't really talked about wealth. So briefly, yes, we are for wealth. There are two big taxes that students must know. But again, this is already something we mentioned in AS, the inheritance tax and the capital gains tax. So there are two examples of direct taxes, of course. Students should simply know what this is. So inheritance tax, when somebody dies, you just inherit their assets, could be money, could be houses. And of course, the government will just take a certain percentage of the overall value of the deceased person's estate. So yeah, it's a tax on wealth. When it goes from one generation to the other. And capital gains tax, well, when you buy an asset at a certain price, if you resell it a few years later at a higher price, you make what we call a capital gain. It's the difference between the price at which you resell it and the price at which you bought it. And again, the government say, hey, well, you made a capital gain, good for you, but I'm going to take a certain percentage of your capital gains. For example, in France, it's a flat tax. Everybody pays 30%. Could be for stocks, for bonds, for cryptocurrencies, doesn't really matter. As soon as you make a capital gain in France, you pay 30%. Okay, so for example, if I buy a house, 1 million euros, I resell it 2 years later, 3 million euros. So I have made a capital gains of 2 million euros. The government will take 30% of those 2 million euros. Okay, so of course, again, it's a tax on wealth. Okay. Good. Actually, I'm not going to talk about negative income tax now. I'm going to skip this. I think it makes more sense to talk about benefits before, benefits and transfer payments. But again, this is something that was already discussed in AS, so I'm going to move pretty quickly on this. So transfer payments or benefits, because transfer payment is the definition is a bit general. A transfer payment is any one-way payment that goes to someone. Could be a business, could be a household, without receiving anything in return. Okay, so there is no production of good or service in return. And it's not necessarily from the government. Okay, so for example, if I give a hongbao for Chinese New Year, it's going to be a transfer payment, or even though I'm not the government. If you make a gift to someone, or if you send money to your family, that's a transfer payment. A benefit, especially a monetary benefit, is a transfer payment, yes, but from the government to people, mostly to people. We don't really give benefits to firms, right? So yeah, a benefit is a transfer payment given by the government to some beneficiaries, usually that are in need. Usually, well, there is a reason for which we give them benefits. All right, so that's basically a benefit is a bit more narrow than a transfer payment. It's a specific type of transfer payment. Yes, and we can use these benefits, we can use these particular transfer payments to reduce inequalities, especially if we give benefits to those who have sufficiently low income. And you know that we call that means tested benefit. If we give universal benefits, the same benefit to everyone regardless of their income or wealth, it's not really going to reduce inequalities. So if you increase everyone's income by $1,000, at least in absolute value, as a percentage, yeah, it's going to reduce inequalities, but in absolute value, it's just going up. Everyone is going to have more money, but the gap is going to remain as wide. Okay, if you want to reduce the gap between rich people and poor people, you should only support the income of those whose income is sufficiently low. Okay, so of course, if we talk about which type of benefit is most effective to reduce inequality, well, means tested benefit, of course. All right, so yes, governments often use benefits to reduce income or wealth inequalities, especially means tested. Okay, the means tested benefit, which are benefits only paid to households whose income or wealth falls below some minimum. Yes, and there are several examples. Again, I talked about that in AS. These examples here are mostly from the United States. These are all means tested benefit, could be in kind or in or monetary benefit that only go to people whose income is too low. Right. And this is the opposite of universal benefits, which go to everyone. Okay, in most countries, child benefits are often non-means tested. They are often universal. It doesn't matter how much money you make. If you have a child, you can receive a certain amount. So, for example, in France, child benefits, they are universal. It doesn't matter if you are a billionaire or if you are unemployed, you receive the same amount. I think it's something like 400 euros when your child is born, and then you receive 70 euros per month. And again, you can be Elon Musk, you can be Jeff Bezos, you can be a billionaire, you can be Jack Ma, you would receive that. So the main advantage of universal benefits is that it's simple, because you give the same thing to everyone. So you do not need to collect data, and that makes the system very cheap to put in place. The main disadvantage is that sometimes you give money to people who don't really need it, and therefore you basically waste this money. There is an opportunity cost. This money has been given to someone who does not generally need it, and therefore this money could have been used for something better. So that's the main problem with universal benefits. And they do not really reduce inequalities because you give the same amount to everyone, at least not in absolute value. Means tested benefit, yeah, so of course it's we understand what is the main advantage. The main advantage is that you only give money to those who are the most vulnerable. You only give money to those the most in need. The major so it's more effective to reduce inequalities, of course. Okay, that's what I did. You only support the income of those who earn a little. The main problem is, of course, you have to determine who can receive the benefit and who cannot. So you need to set some thresholds. You need to collect information about how much people make, how much their spouse makes, whether they have assets. People might want to misreport information to earn the benefits. So you see, it's way more complicated. It's much more heavier in terms of organization, and therefore much more costly to put together or to distribute those means tested benefit. And this can give rise to this poverty trap. What basically the idea that if we give means tested benefit, this can reduce the incentives to work. Let's talk about that briefly. The poverty trap. So there are actually two things. There are actually two things that contribute to create this poverty trap, but in both cases, it's about the idea of the incentives to work, and the idea that if you tax people too much when they earn more, or if you remove the benefits too fast when they earn more, then they will have low incentives to work. Okay, let's just take the problem one by one. Okay, let's not mix taxes and benefits at the same time, or it's going to be a bit complicated. But let's say that, let's just assume that unemployment benefits, they are means tested. Okay, but they are very high, and they are very high. So let's say that if you are unemployed, you can get $1,000 in unemployment benefits. And you could also choose to work, and you would expect to get the minimum wage at $1,200. Okay, so if you choose to work, you will get just a little bit more, because of course, if you work, you lose the unemployment benefits. And you would only increase your disposable income by $200. So you see, in that case, if you have means tested benefits that are too high, people might simply choose not to work. Okay, because, well, they might simply value the leisure time more than $200 extra per month. Okay, so that's the idea. And same thing with taxes. So it's a bit different for taxes. It's mostly for those who already work, but if they have the opportunity to work more, to make more income, if they anticipate that the government is going to take, let's say, 40, 50, 70% of the additional income earned, well, again, there are low incentives to work more. And you're going to ask me, why is this a problem? Well, because that means that we do not use a productive resource, labor, to its full potential. People could work more and therefore could produce more, but they choose not to because they believe it's not worth it, because any extra income that would be generated would be taken away by the government. Of course, not all of it, but a large proportion of this additional income would be taken away by the government in the form of more income tax, and therefore they choose not to work more. So that's the idea, basically. All right, so a poverty trap is a situation in which an individual receiving means-tested benefit has no incentive to take a job or to work longer hours, because any additional income would be taken away in additional taxes. Because of course, if you start working, you start to pay income taxes usually, and lost benefit. Okay, so to keep it simple, basically, you don't want to work more because you feel like your disposable income would not increase much. So you are not willing to sacrifice some of your leisure time in exchange of a very small increase in disposable income. Okay, that's basically the idea. Just remember, poverty trap, low incentives to work or to work more when they are high means tested benefit, or when they are very high marginal tax rates. Okay. Right, some data from the US that, so what we have here, you have different age groups. we have the population below the poverty line without taxes and transfers. Okay, and here you have the poverty rate, so the percentage of the population below the poverty line after taxes and transfers. Okay, so that's basically gross income, so before tax and before benefits income, and this is disposable income. And of course, you see that the percentage of the population below the poverty line significantly drops thanks to taxes, progressive taxes mostly, because when we talk with taxes, it's mostly through direct taxes, okay, not indirect taxes. And transfer payments mostly means tested benefit. Here, you see that the poverty rate falls among all age groups, especially people 65 and over, well, mostly because they are retired. So their before tax income or before tax and before benefit income is often zero. So yes, if you do not include pensions, the poverty rate would be very, very high. So these are the ones who mostly benefit from benefits like Medicare in the United States and state pensions and yeah, benefits and taxes. All right, same thing. We have also some data from the United States about the share of total income that would be earned by each age group of the population in the US. So before we redistribute income and after we redistribute income, again, through direct taxes and transfer payments, benefits. And of course, you see that in this column, there are pretty significant inequalities. You see that the bottom 20% of the population would actually earn less than 1% of total income without direct taxes, without benefits. But with taxes and benefits, they earn close to 4% of total income. So they clearly benefit from this income redistribution. Same thing for the second quintile, from 7 to 10. So they also benefit. Same thing from the third quintile, from the 40 to 60% of the population, 14 to 16, but they benefit less. You see that the gap is smaller. You see that for the fourth quintile, it doesn't make much of a difference, all right? Because they basically probably pay as much tax as they receive in benefits. And for the top quintile, they lose, of course, because they are the ones who pay more, or the most direct taxes, and they don't receive much benefit. Okay, so their income goes to the other quintiles of the population. Okay, then I can come back to the concept of negative income tax. Why did I keep it last? Because yes, a negative income tax, it's a combination of taxes and benefits. So actually, I think it makes more sense to save it for the end. And I don't know why, it's some students are very scared about that, this concept, but it's actually very, very simple. The idea is that you pay taxes if you make more than a certain amount. And if you make less than a certain amount, you receive money. Okay, so receiving money is like paying a negative tax. Okay, it's like if your tax rate is negative, and that's why we call that negative income tax. Okay, so above a certain income, you pay a positive tax. Below a certain amount earned, you pay a negative tax. So paying a negative tax is just receiving some benefits. And in this case, means tested benefit, because you only receive them if your income falls below a certain minimum. Okay, so how does it work? First, households, they will, if they make more than a minimum, they pay income tax to the government. So it's a transfer payment from households to the government. If a household earns less than this minimum, then they receive a payment from the government. And of course, the amount they receive is a proportion of the gap between what they currently make and the minimum threshold. So of course, the lowest your income, the more you receive, basically. And the highest your income, the more you pay. Okay, simple. Yeah, so it's very easy, right? It's a very simple system that combines the payment of a tax with the provision of a benefit. All right. Honestly, students, they are not expected to know too much about negative income tax. They should just know how it works, basically. And of course, the advantages and limitations, they are not so important. This slide, you can really skip it, frankly. I like this diagram, though. You should really show them this diagram. And if they could use it in an essay, that would be amazing, really. So you strongly encourage the use of this diagram. So what do we have? We have on the horizontal axis, we have Y, which is the gross income, so the income before tax, before benefit, okay? And on the vertical axis, we have gross income and disposable income. I'm going to show both. So first, let's just draw a 45-degree line, which represents my gross income. Okay, so just pretty easy. And then let's just choose this, what we call the break-even income, which is going to divide my population into two halves. So those who make less than this, they will receive money. And those who make more than this, they will pay tax to the government. Okay. So when you think about it for a second. If you make less than that, then you receive money from the government and you don't pay taxes. Okay. You pay zero taxes, direct taxes, and you receive a benefit. So in that case, your disposable income is higher than your gross income. However, if your income is larger than this, you don't receive a benefit, you pay a tax. So your disposable income is less than your gross income. So how can we represent the disposable income? So yes, these households, they receive a payment. Those households, they make a payment. So this is the disposable income. Again, those below the break-even income, their disposable income is higher than their gross income because they receive a benefit. Okay, so that's the negative tax. Negative tax here, it just means the benefit that you receive. And those above the break-even income, they pay a tax. So this is the tax revenue, and therefore their disposable income is less than their gross income. And that's it. It's easy, right? It's very easy. That's how you can represent a negative income tax system. The red shaded area would be the positive tax, and the green shaded area would be the negative tax. So yeah, you just combine the payment of a tax with the payment of a benefit. Easy. Cool. Any questions at that stage, Caitlin? Okay. So we are almost done. I think there is one last thing very briefly about the intergenerational equity. Only 2 slides. Well, but it's important. I feel like it's very important. So it means the equity between generations. So because yes, basically our actions have consequences for on our generation. Yes, but our actions, our decisions, especially from the perspective of government policy, will have consequences on future generations. And of course, when we say that, we often talk about sustainable development. We often talk about the environment. And yes, it is a very good example of intergenerational equity to make sure that what we do is not only fair for the current generation, for the present generation, but that it is also going to be fair for the future generation. So yeah, and the idea underlying this concept is that when governments make decisions, they should have like a long-term view. They should not only focus on the short-term consequences of their actions, but they should take into account the interest of future generations. Okay, so to take the interest of both the current and future generations. And there are actually 2 ways things can be 2 ways things can go. You can have a decision today that is going to be good for your generation, for the current generation, but that is going to be bad for future generations. For example, if you choose to extract a lot of natural resources, all right, actually, it might be good for the present generation because it means that we are able to produce a lot of capital goods, consumer goods, to stimulate economic growth, to increase income, to have much higher living standards. Okay, that's amazing for the present generation. But of course, for future generations, this might lead to climate change. This can lead to pollution. This can lead to the depletion of some non-renewable resources that have just depleted. Okay, so that's a typical example of a decision that is good in the short term, but bad in the long term. Okay. All right, so you have some examples. Or for example, the problems we have with nuclear waste. All right, so you know that we don't really know what to do with those very highly radioactive waste. So what we do is right now is that we usually bury them very deep underground. So the fact that we use nuclear energy today provides great benefits, absolutely. But it might, we don't really know yet, but it might have very harmful consequences for future generations because you know that those wastes, they will remain radioactive for thousands of years. Okay, so they might be long-term costs for future generations. Future generations, they might suffer from decisions that we have made today. Okay, but it can also go the other way around when governments make decisions that are bad for the present generations because they are good for future generations. Okay, so we justify a decision that harms our present generation to protect future generations. So for example, we could develop renewable energy policies, okay, especially to produce electricity using wind turbines, using solar panels. And why is this bad for our current generation? Because it makes electricity more expensive. It's much more expensive to produce electricity with the wind turbines than with, I don't know, burning coal, for example. But it is much better for the future generations. Same thing, protection of endangered species. Of course, it's great for future generations. This is the concept of mostly option value. But it can be bad for the present generation because it means that there are some areas that we cannot exploit economically. Okay, well, you have many examples, and that's really the idea. Our decisions today, they have consequences for our present generation, but they also have consequences for future generations. And the concept of intergenerational equity is basically the idea that decisions that we make today should not only focus on short-term consequences, but they should take into account the interest of our children, grandchildren, and so on. That's essentially the idea behind sustainable economic development. Okay, and yes. Okay, good. Questions, Caitlin? Are you ready to move to the very short topic about government failures? They are only 4 slides. All right. Okay, again, this part is mostly a summary of what we discussed so far. We have already identified some limitations of government intervention, both to correct market failures and to reduce inequality. And in this, and it's very important because you know that every year there is one question about efficiency, market failure, government intervention. And for this essay question, the structure is almost always the same. Efficiency, what is it? market failures, solutions, and the limitations of government intervention. That's usually how you structure an essay about efficiency or inequality, but usually it's efficiency. So there is always, especially for the evaluation, students should recognize that government intervention has some limitations. And that's why I summarized all the possible problems that can exist or can occur when the government intervenes in the economy, either to improve efficiency or improve equity. Okay, so that's essentially what we mean by government failure. So yeah, when the market fails, the government may decide to intervene to restore efficiency. And actually, I forgot to mention that also the government might want to intervene when there are inequalities. Okay, these are the two main reasons for which the government might want to intervene. But sometimes the government is going to fail to make things better, can actually make things worse, or at least it might not be able to achieve the intended goal or target. And we call that government failure. So government failure might be we make things worse, we create new inefficiencies, or we fail to achieve our target. So maybe we have improved things a little, but we have not completely fixed the problem. We have not fully corrected the market failure. We have not achieved the level of income equality that we hoped. Okay, so of course this is something that matters, because it means that it's not always a good idea for the government to intervene. Basically, the idea is that government intervention has some benefits. Yes, absolutely. But government intervention can also have some costs. And whether or not the government should intervene depends on the balance between the cost of intervention and the benefit of intervention. So yeah, governments, they should engage in a cost-benefit analysis before they determine whether or not to intervene in the economy to correct a market failure or to reduce the gap between high and low income households. Okay, so what are the main reasons for government failure? Well, the first one, which is true for basically all problems and all solutions, is information. If we want government intervention to be effective, it is necessary that the government has good information about what the problem is. All right. So it could be about the size of the externality, could be about the how much public goods should be produced, should be about, all right, we should introduce a regulation, but how tough the regulation should be. For the introduction of a minimum price, we might need some information about the price elasticity of demand. Of course, when there is a problem, if you want to solve it, you must understand the problem very well, and you must understand the consequences of your actions very well. And in practice, it's not always the case. Governments, they do not have a perfect information about the size of a market failure and about the consequences of the policy instruments that it might use. And same thing when we introduce policies to reduce inequalities. So that's the first problem that is true for all possible types of intervention. Information. Bad information or poor information on the side of the government is likely to lead to an ineffective government intervention. Second problem is what we call perverse incentives. Well, if you don't like this word, you can replace by unintended consequences. Unintended consequences, which is basically, okay, you want to achieve something, but this leads to something else. This leads to something that you really did not expect. The famous example is the Cobra fact, which is something I believe happened in India. I forgot when. You can Google it if you want. But there was a problem with cobras, which is a dangerous snake, poisonous snake. So the government started to say, all right, there are too many cobras, it's dangerous. So we're going to reward those who kill cobras. So if you see a cobra, boom, you kill the cobra, you bring it to the local government, and they will just say, hey, look, I killed a cobra, and then you will receive money. Great idea, right? But the problem is that people realize that, hey, actually, I can make a business. I can breed cobras. I can start my own cobra farm. I can raise thousands of cobras. Then I kill them and I bring them to the government and I receive money from the government, right? Uh, and because of that, people started to breed cobras simply to sell their dead bodies to the government. And of course, the program was unsustainable. It was stopped. And at the end of the day, there were even more cobras than before, because those who had cobra farms, they just abandoned the snakes, and we ended up with more cobras than at the beginning. So it's you see an unintended consequences. You do something that sounds like a good idea to solve a problem, but people respond in a way that you did not expect, and this makes the situation worse. The red cockaded woodpecker is another story. It was in the United States. There was a so the red cockaded woodpecker was a very rare bird in the US, and the government wanted to protect it. So they implemented a policy that said that as soon as this bird is spotted in one area, the government will basically take over this area, protect it, and prevent people from exploiting the area. Okay, so let's say that you own a forest, and what you want to do is to cut the trees and sell the trees. Okay, well, you can do that. But if you spot a red cockaded woodpecker in your forest, well, if you tell it to the government, then the government will say, all right, so then I take control of your forest and you cannot cut the trees anymore. You cannot sell the wood anymore. Okay, so it sounds like a good idea to make sure that the red cockaded woodpecker are protected, that their natural habitat is preserved and they can survive. All right. But of course, what happened? The landlords, those who owned the land, the forest, they did not want the government to seize their land, to take control of their land. So guess what they did as soon as they spotted this this very rare bird? Well, they just shot the bird. Well, just to say, no, did you see a bird? No, I didn't see anything. No. So at the end of the day, this bird, I don't know if it completely disappeared, but you see clearly that this regulation of this new law that was intended to protect this bird led to the complete opposite situation, where people had an incentive to kill those birds. Slave redemption is another example where there were some NGOs who said, hey, I have a great idea. There are too many slaves in many countries, so let's just buy them. Let's just buy the slaves, and then we set them free. Yes, great idea. Well, it makes sense, right? You buy the slaves and then you set them free. But again, from an economic perspective, what happens if you buy slaves? You increase the demand for slaves. And if you increase the demand for slaves, you increase the price of slaves. And therefore, you give more incentives to those who enslave people to enslave even more people. So at the end of the day, this just encouraged slavery because you could sell slaves at a higher price. So again, you see, you have basically what we call perverse incentives or unintended benefits. You have a good idea, but it leads to something you did not expect, because sometimes people's response to your policy is unpredictable. All right, and the poverty trap, of course, you give money to poor people hoping that it's going to support them, but at the end of the day, this just discourages them from working. Taxation, you have the problem of a deadweight loss, of course, especially if you want to give subsidies. You want to subsidize merit goods, you want to produce public goods. Yeah, okay, that's a great idea. You can correct a market failure by doing so. But if you want to subsidize merit goods, if you want to provide public goods, first you need to collect tax revenue, for example, using VAT. But you know that indirect taxes in markets, they create inefficiencies, they create deadweight losses. So you might reduce a deadweight loss in the market for merit good, but you might create another deadweight loss or increase the size of a deadweight loss in the market for a product on which you impose a tax to finance the subsidy. So this is also something that we have to take into account. Obviously, there is always the problem of lobbying and political interest. In theory, governments are benevolent and they make decisions to benefit the economy, to benefit society, but you have powerful lobbies, groups of interest that try to corrupt politicians, to influence their decisions. Of course, politicians, they might also be interested in their re-election, so they make decisions that will allow them to win the upcoming elections, even if they are not very efficient from an economic perspective. So this is also something that can undermine the soundness of government intervention. There are, of course, some trade-offs, what I mentioned today, between efficiency and equity. So there are some distributional effects, which means that a policy that is meant to improve efficiency can actually increase inequality, but I talked about that already, so I'm not going to repeat myself. There are situations where governments, they have multiple objectives, multiple macroeconomic objectives especially, and then improving or attaining one objective can prevent the achievement of another. So for example, you can choose to deregulate the airline industry, so you can improve competition, you can stimulate competition and improve efficiency. Yes, that's good. But if you deregulate the airline industry, this can lead to lower prices, and therefore more people want to travel by plane. And at the end of the day, this creates more negative externalities. So you have a trade-off between two market failures. You have more productive efficiency, less market powers, but more negative externalities. So same thing, it's a trade-off between market failures. Political interest, I've already talked about that. Yes, you can have economic policy that is populist, which is just meant to make people happy so they vote for you during the next election. There might be some administrative costs, of course, implementing regulations, for example, designing the regulations to implement them, make sure that people comply, that the regulation is actually enforced, is very costly. Same thing, collecting taxes is very costly, to chasing people who don't pay, to fight tax evasion, tax avoidance. These are things that are very costly. So intervening is definitely costly. And of course, in the case of a state provision, where you have a public monopoly, a state monopoly, one single national firm producing for everyone, you have the problem of inefficiencies, no competition, therefore low incentives to achieve productive efficiency. And this might result in a waste of productive resources because of the absence of a profit motive. So I went a bit fast on this, mostly because everything we talked about this already, apart from the unintended consequences, and that's why I spent a bit more time on this, but everything else is just a summary of the different possible problems and the different limitations that are associated with government intervention, and that should be mentioned in an essay, especially to evaluate whether or not governments should intervene either to correct market failure or to reduce the gap between high and low income earners. Okay, and I'm done. Caitlin, do you have any questions? No? Okay, you're welcome. Thank you for joining me tonight. So next week, the labor market. Ooh, tough one. Labor market part 1. I think you have already signed up, Caitlin. If you have not, you are welcome to do so. This is only part 1. And remember, everyone, if you're watching this video, Today I have created a new event on Econ Mentor, the labor market part 2, because I will need 2 weeks to cover this entire topic, not simply one. So if you have not registered for the last workshop that we'll do together, labor market part 2, go to econdoctor.com/mentor and you can sign up for this last workshop together. All right, thank you very much, Caitlin, for joining me tonight. Have a nice evening, everyone, and see you next week. Bye-bye.